Okay, I want to give you some insight on the FS2, the Current Company Research Project. So you just need to pick a company, any company that you're interested in. And many of you have already sent me your company. And it could be Chipotle, it could be Home Depot, it could be General Mills, any company that you want to investigate whether they're, well, consider what the likelihood is they're committing financial statement fraud. And the first thing you want to do is do a very detailed analysis, do a vertical and horizontal analysis, and like you did in FS1, and consider where there could be some unusual fluctuations. So is accounts receivable going up significantly relative to sales? Has there been significant increase in net income or revenue relative to their competitors? Are their competitors, losing business and they're growing? Consider the industry. And one of the things you want to consider specifically is accrual. So compare net income to cash flow from operations. Companies that are committing fraud, the net income is not real, so there's going to be a big difference between net income and cash flow. But just because their net income is high doesn't necessarily mean that relative to their cash flow from operation, doesn't necessarily mean that they're committing financial statement fraud. It could be a growth company. That's what happens with companies that are growing. They have a lot of sales and the receivables are up, and so they just haven't collected the money yet. But companies that are committing fraud traditionally have much higher income relative to cash flow from operations. And then the other thing that you want to consider is non-financial information. So like in the example, or in the PowerPoint presentation that we went through using non-financial information to assess fraud risk, what you want to do is read the 10K and look for non-financial information that they disclose. Like if you're looking at Chipotle, they probably tell you how many stores they have, right? And I don't know if they give you some information detail about customers. They'll probably give you detailed information about how many employees they have. So you want to compare, their stores. So you have to go to current year 10K and the prior year 10K because they don't usually give you 2 years worth of information, and compare that information across time. And if they're adding more stores, they got 10% increase in the number of stores, you'd expect possibly a 10% increase in sales revenue. Right? But if they have fewer stores and they're laying people off, you wouldn't expect an increase in sales revenue. So you want to go to the 10K and look at the prior year and current year non-financial information and compare it to revenue and to total assets. The other thing that you want to consider is compensation to and total stock ownership of executives. So the way that you do that is you go to the SEC website. I'll show you here. I just brought up Google's proxy statement. But the way I did that, I'll go back, is you go back to the SEC, search on Edgar company filings. I just did a search on Google. I clicked search and brought up Google. Now the company that you're looking for, there's a lot of Googles. The one with the SIC code is going to be the one that's the main company. So you click on that. Then you want to look to find the proxy statement. It's called Form DEF 14A. So just type in DEF, do a search, and it brings up their DEFs. The DEFAs are amendments. You want the DEF 14A. So click on that and click on the document. And this is their proxy statement. See, it says proxy statement. And this tells you who's on their board of directors and how much money they're paying to their board of directors and what they're paying to their executives. So if you scroll down quite a ways, this has a list of voting information, has a list of their board members, who their auditors are, the audit fees. So there's a lot of good information. If you go down to the table of contents and flip down to their executive summary, so you got this executive summary here, and it's going to have a list of, it's going to talk about their pay, and if you keep going down, it's going to give information related to how much cash and stock compensation they actually received. So here's a list, for example, stock awards that were granted, but we want to go down and find the total information about options. Here's the summary compensation table. So Larry Page, who's the CEO, actually took $1 in salary, and that was it for the year. So this is obviously a very unusual situation. Same with their co-founder. But they have millions and millions of shares already. So any increase in the share price increases their stock compensation. Now, Eric Schmidt, who's the executive chairman of the board of directors, has a salary of $1.25 million, bonuses of $6 million, stock awards of $100 million. There's a little 3 up there, so if you come down, amounts reflect the aggregate grant date, fair value of stock awards computed in accordance with FASB. The statement here, not necessarily an indication of actual gains for previously granted awards. So this is his stock award, the value of the stock awards, and he's got another $1 million in other compensation. You can look and see what that is. It generally consists of 401ks. So Eric Schmidt received a total of $108 million in 2014. 2013 it was $19 million, so not very well paid 19, and $7 million the year before. And so you can see what these executives are paid. It'll also tell you, if you scroll further down, information about their total stock that they have in the company. But obviously, with a lot of stock-based compensation, Eric Schmidt has incentive to grow the share price, because these stock awards, his increase in his personal wealth is going to grow significantly compared to the if he can get the stock prices to go up a little bit, because he owns so much stock. So that provides incentive to potentially manipulate the financial statements if reporting accurately would cause the stock price to go down. So go to the proxy statement. You can gather a lot of useful information about the company here. Like I said, it also has the board of director information up here. So that helps us determine if there's insiders on the board, because if we go back to FS2, has considered board of director information. So firms with a high percentage of insiders on the board of directors are a higher fraud risk. And by insiders, we mean employees of the company. So the more employees that are on the board of directors, the less oversight. So there's one less level of oversight, because the CEO is not going to if he's the chairman of the board, there's nobody overseeing the CEO. So, if you have the CEO as chairman of the board, again, it's less oversight. So a lot of companies do this, especially companies like Google, who the founders, the CEO and chairman of the board. That doesn't necessarily mean that they're committing fraud, but it is one less level of oversight. So if you see, he's got the chairman of the board, he's got a lot of executive compensation, right? There's some concerns about the non-financial information where, maybe the number of products that they sell, or the number of patents that they have for their pharmaceutical company, or if they're a hospital, they have fewer beds or fewer doctors, but the revenue is going up. You add all these things together, and revenues, net income is significantly higher than cash flow from operations. You have accounts receivables, relative to revenue seems to be going up too much. So you start aggregating these red flags. You start to think that, well, maybe there is something to this. Maybe the potential that the company is committing fraud. And then the other thing is you want to consider the company's stock price if it's overvalued, because once your stock price gets overvalued, then the definition of being overvalued is the investors expect better future performance than you can actually provide. So that's going to put a significant amount of pressure on you to meet those unrealistic expectations. And so you want to calculate the company's market cap, their PE ratio, the dividend yield. So think of all the different ways that we value stocks and compare that to their competitors, and that'll help you determine, is it possible that this stock price is overvalued? And if so, then that's going to put pressure on them to report earnings that may be higher than what are actually the case. And then consider other factors like how understandable their 10K is. So, companies like Enron that were committing fraud, one of the reasons why Chanos was able to short sell them is because he read their financial statements and he wasn't clear from reading the financial statements. He read the notes about how they recognized revenue, and it wasn't clear to him how they were doing it, where the revenue came from. He read the related party transaction footnote, saw that they had related parties transactions, suspected that maybe that something was suspicious related to that. But there wasn't enough information in the note to explain the extent of those related party transactions and what exactly they were doing, and that also raised red flags. So if you read their 10K, and especially the notes where they describe their accounting methodology and the revenue recognition methodology, if you can't understand that, or it seems inappropriately vague, then you might be suspicious that they're potentially committing fraud. So you add all these things up, and those are the things that cause you to think that maybe this company is committing fraud. And what I want you to do for the project is just to report, in the end, after doing all your analysis, is the company a high, medium, or low fraud risk? And I'm not going to grade you on whether you decided that they weren't a high fraud risk. It's not like determining that they're high fraud risk is the right answer. The right answer is whatever it is that you find, and then you want to be able to just back up your assessment for fraud risk. I mean, it could be that they don't have any of these factors, and you think that the fraud risk is actually low at the company. So the main thing is that you provide a conclusion and you support that conclusion. And if there's any other items that you think are useful, you can include those. In the past, some people have looked at the Benesch score. I don't know if anybody has used that. If you've taken valuation, you may have run into the Benesch M score before, but if you just click here like Investopedia, it'll give you some definition. It's basically has some financial statement ratios that you want to calculate, and then it comes up with you come up with an actual number. This doesn't have the formula. Let's look down and see if we can find the formula for the Benesch score. Here it is. So you take these numbers, these coefficients, and multiply them by these ratios, and that'll come up with a score. And then the more negative the score, the more likely they are that they are committing fraud. So that's something else that you can consider on whether this company is committing fraud. And so the main thing is that you provide a conclusion and that your analysis supports that conclusion.